Everyone loves predictions. Sports, politics, markets, even chess. Doesn't matter. If it can produce a winner or loser, someone is going to make a prediction, and even more will risk dollars betting on the outcome. You can go from hero to zero in a New York minute if you make the wrong call. It's the nature of the beast, and it's the risk we take generating a market call or a stock prediction. Right now, strategists like myself are reading the tea leaves, trying to come up with a 2023 game plan. The elephant in the room is still the Federal Reserve and where rates are headed. Key to that, of course, is inflation expectations. On Thursday, we got another inflation print that continues to head in the right direction. The CPI, Consumer Price Index, came in down 0.1%. That's what I said, down month over month, the first negative print since 2020, and even more important, 6 months of a falling CPI since it peaked in June. Oil, airline fares, and used cars all chipped in with lower prices to help drive consumer price inflation lower. Despite this good news, markets ended the day with a yawn, up just 0.3%. So where's the love, and what's it going to take for stocks to finally break out of jail? This is your Market Minute. Welcome to the Money Runner. I'm David Nelson. To be fair, stocks had already rallied on the heels of a softer than expected wage number last week. And on Wednesday, added to those gains in advance of Thursday's inflation report. Bottom line, while inflation is well off the highs, the bigger challenge will be to go that last mile and approach the Fed's long-term target of 2%. So what does that mean for markets this year? Right now, there's a market disconnect. Markets are pricing in a full Fed pivot. And on the other side, the Fed continues to send a tough message that rates need to move higher. In fact, Minneapolis Fed President Neel Kashkari is on record saying the Fed needs to hike to 5.4%. Fed is talking tough, and investors aren't buying it. One of them is wrong. This is what the bulls see. 2-year yields have stopped going higher, and the terminal rate, or the peak Fed funds rate expected by investors, has been moving sideways for the last few months. Here's where I come out. 2023, it's going to be a transition year. It's going to take the next 6 months at least to digest higher for longer rate policy. The good news is that the current terminal rate may be enough to tame the inflation beast, taking away some of the potential downside in stocks. However, to get inflation to fall and go that last mile back to 2%, we're going to have to live with an elevated Fed funds rate for a lot longer than the market suspects. For my call to prove wrong, we're going to need to see something different out of earnings. We can't expect multiple expansion this time to hold us up. Not with rates approaching 5%. The Fed may stop hiking, but unless we see significant progress on reaching that 2% goal, I don't see them cutting. That leaves earnings. And in the long run, that's what stocks follow. I think a 10% return this year, I think it's doable. But most of the gains are going to come in the back half of the year. In part because I think margins are going to be a challenge in the front half. Markets are a forward-looking mechanism. And by June, investors are going to shift their focus to 2024 earnings, which I think have a lot better shot at delivering. All right, let's shift gears. Let's talk charts. The S&P 500 has been trapped in purgatory of this downtrend that started over a year ago. Stocks have been rejected 1, 2, 3, 4 times, trying for a fifth. Maybe this time is a charm. To be convincing, stocks will have to break above that downtrend and even better, take out the previous high and start to live there. Price momentum, pretty powerful tool. And if we get a breakout just south of 4,100, that would force a lot of short covering and performance chasing. Earnings season is just kicking off right now, but I can tell you more important than the headline numbers is the commentary on the call. Let's hear what they have to say. Hey everyone, I'm going to break in real quick here. We just had a kickoff to earnings season. Three of the largest banks just reported: JP Morgan, Bank America, and Wells Fargo. Looks like JP Morgan and Bank America looks like earnings beats. Wells Fargo, a pretty significant miss. All three are trading down in the pre-market. Let's see what they have to say on the call. I'll be back as soon as I can. If you like today's pod, hit subscribe and don't forget to tell us what you think. Thanks for joining. I'm David Nelson.